This episode's sponsor is Blockdaemon. It's the gateway to the decentralized economy. If you're serious about crypto infrastructure, Blockdaemon is the partner trusted by top-tier financial institutions and the biggest names in Web3. Visit blockdaemon.com to get started or book a call with their team today. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research. Nothing said on Forward Guidance is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice, or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the company's funds or projects discussed. All right, what's going on, everybody? Welcome back to another Roundup edition of Forward Guidance. Back with the trio once again, getting back into the flow of things, all three together every week. Just love to see it. What's going on, guys?
Not much. It's just I'm so grateful. We have two in a row with Tyler. It's amazing.
Yeah,
he's blessing us with his presence.
Quinn doesn't have this Hugh Grant, wavy, floppy hair. You got a haircut? Look at that thing.
It's still there, bro.
Oh, is it? Oh,
yeah. I didn't get anything off the top. Just cleaned up the sides. So
okay, you look more surfer bro, like Mitchell Guzin, circa 1990. I don't even know.
Next time you see me, it's gonna be blonde. I might just go full rogue.
Yeah. All right.
Yeah.
Gotta start it with a roast.
Oh, you always got it. Keep them honest. All right, guys, let's chat about. We're recording here Thursday mid-morning, and this comes after the fiscal bill in the House got passed overnight. Looked like it was a pretty, just a late working until the late night hours. Finally got that thing done, and now we can start to think about. Obviously, it needs to get passed through the Senate, but we can start to get a bit of an idea of where I think the next big narrative is headed. And we started to touch on it last week too, in terms of just the complete 180 on the fiscal situation. And yeah, I think it's a really notable shift that is I'm still coming to terms with it. I feel like a lot of people are as well. And what was really interesting too was an interview that Scott Bessent did on CNN last week, which I think really tipped his hat towards how they're starting to think about this. I don't know, we can debate if it's a strategic pivot or not, but the language is a lot more about running it hot to outpace the debt. Scott Bessent in the interview mentioned that they inherited a 6.7% deficit to GDP, and now their focus is on running the economy faster than the debt, and that's their focus for stabilizing debt to GDP. Which Luke Gromen always has great sovereign takes on things, and he mentioned that when the U.S. Treasury Secretary tells you holders of long-term treasuries are going to lose money on a real basis, you should probably believe him. So complete 180 in terms of just looking at this is just the breakdown of this bill, and effectively there's $2.75 trillion that needs to be funded for this bill through Treasury issuance. So Scott Bessent's got a lot of bonds to sell. If they want to see this happen, there's been a lot of different calculations in terms of how to square this out. But overall, it seems like the net impact is significantly higher deficits with a lot of the tax cuts and stuff front loaded, and then some of the savings coming on later on. So up front, it's looking like we're going to an 8% of GDP fiscal deficit world, not the 3% or whatever that was hoped originally. So yeah, how are you guys thinking about this pivot? Because we've gone from a few months ago, the discussion was Doge and all these different ideas of basically reining in fiscal spending. And I will admit that there's some pretty important inconsistencies within this analysis in terms of the fact that most notably tariff revenue is not a part of this calculus for the deficit. So if we're running a 15% effective tariff rate and that actually holds, that's $400 billion annualized a year of revenue, of net new revenue. So obviously some of these dynamics will potentially be offset. But yeah, what's your guys' high level read on how you're thinking about the situation right now?
We've been kind of talking more and more too about how the scoring is done, whether or not it's all so political, you don't know what to believe, but whether or not the tax cut extension, a lot of that is just status quo and assuming that actually would have come undone. I mean, I think it's just fair to assume that just status quo, really. I think there's probably some nuance to be understood between, tax cut driven deficits versus more like Inflation Reduction Act spending, government capital allocation type decisions, and there's differences probably. My biggest takeaway is just how politically unfavorable and like it's a political death wish it is to cut spending. I mean, this was the most vocal attempt at relative austerity measures in years, and you would have thought, like a noble attempt, maybe that's the wrong adjective, but to balance the budget was intercepted by media and everybody as like the devil. So it's clear, like, you it appears to me to be a pretty big pivot, but it's just
mainstream
yeah,
media.
Agreed. I mean,
it's all boomers. It's all boomers. They don't. This is the thing. Boomers will never let you cut anything. They're
exactly.
never.
It's so
it's,
it. Yeah,
it's the
just all the
Ponzi.
same. Yeah,
The Ponzi.
The Ponzi continues.
You walk down the street, and how many people actually understand the fiscal deficit situation we're in, or what it means? And it's like, consume 2 today and pay off 4 later, but no one cares. Like we're talking about an economy that's propped up on like student loan forbearance, FHA loan forgiveness, and buy now pay later, where 60% of Coachella tickets were financed on debt. So you think anybody in this economy is gonna like want to have any idea to balance the budget? Like, I guess not. So
they got midterms to win, man.
Yeah.
I got a lot of heat for calling it, Weimar Germany. And I don't actually mean that, because that price has doubled like every hour, but you can kind of see the makings of how you get to that situation. Like you said, we're doing buy now, pay later for Coachella tickets. We're
doing it for Uber
everything
Eats.
is debt based. You try to cut some spending for like a month and like immediately reverse it in under a month, and then bang out the deficit even more. This is a Ponzi scheme. It's a fiat Ponzi scheme. And the fact that like there's one trade, there's just one trade. It's either it's Bitcoin, but you're also momentum. Like, and the fact, the amount of hustle that goes into fundamental analysis, when you can just sit back and be like, oh yeah, every firefighter and policeman and teacher in the country is never going to want their pension cut, and they're going to want their Medicaid, and everybody is going to want their student loans forgiven because they didn't even get an education by the time AI takes their jobs. Like, there was such a great meme this week. It said something like, oh, it took out like $160,000 of student loans just for AI to take my job. And so you're like, wait, where is this is happening now? Google just released like this video thing that basically produces movies. And so you go and get like a $200,000 college degree and you have no job. Like, I mean, there's only one trade, and it's just store of value trading. There's growth.
I mean, look at these charts, Tyler. Like, I think it's so key to look at it in like Bitcoin and also gold relative to bonds. Like, to me, this is the generation trade, both of these.
And everything else is futile. Like, you put all the data in to do your PE multiples and your EV to EBITDA and all this other nonsense, and this is absolutely crushing it. Degen traders just riding Bitcoin, they're outperforming the world's best hedge fund managers for years and years and years. And so you have to like step back and wonder, who's the moron here? I don't, that's what I keep going through. I just can't get it out of my mind, is like, we put all this effort into these things that are supposedly like risk-adjusted returns, but the biggest risk is just not keeping up with the goddamn inflation and all the incentives that are just going to keep printing money for generations. And when you say that, like, simplistically, everyone's like, "Oh, you're a moron," and I get a lot of flack for it. But I just think there's one trade, and there goes my rant for the day. I just had to get it out early. That being said, there's good things happening. We got Rocket Lab. I'm adding intuitive machines, 2 space companies. There's lots of great happening in the frontiers, let me tell you.
If you're building anything in crypto or institutional finance, you need to know about Blockdaemon. They've been powering blockchain infrastructure since 2017 and are now securing over $100 billion in digital assets for more than 400 institutions. From institutional staking and node infrastructure to MPC wallets and APIs, Blockdaemon is the go-to partner for performance, scale, and security. Learn more at blockdaemon.com. Today's episode is sponsored by Echo Protocol, the leading Bitcoin liquid restaking and yield layer on the Move VM. Echo is already the number 2 protocol on Aptos, securing nearly half the network's bridged assets with over $200 million in ABTC minted. They're unlocking new layers of utility for Bitcoin by allowing you to bridge your Bitcoin or BTC liquid staking assets and earn yield on Echo land. You can also stake Aptos for liquid restaking rewards like EAPT. Backed by names like Spartan, Maelstrom, Selene, and Aptos Labs, Echo is where Bitcoin meets next-gen DeFi. Visit echoprotocol.xyz to explore staking, lending, and bridging. This episode is sponsored by Arkham, a crypto exchange and analytics platform that lets traders and investors review on-chain data, then take action in the markets. With Arkham Intel, you can see what top traders are buying and selling, and then trade directly on that information through Arkham Exchange. Arkham was built to make blockchains human-readable, simplifying data into meaningful insights for the average crypto user. To start using on-chain data as your edge, go to arkham.com. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research. I think what's so wild too is like just looking at the fiscal deficits as percentage of GDP and just how hot the US is running. Because, it's interesting. I interviewed Kevin Muir this week and we talked a lot about the fiscal situation at hand. And he made this interesting point that, you often ask people on the street or whatever, like, who runs the biggest deficits? Who spends too much government money? And they're like, oh, well, probably those socialists in Europe and those communists up in Canada. They're the one running the fat deficits. But you can make the argument like, look at Canada. We're at barely 1% up here in terms of like we're arguably underspending. And there's some valid cases to be made that we have not contributed enough to NATO and the like versus the US and other countries. But yeah, there's no coming to terms right now from any Congress people that I've seen really about trying to navigate this fact that, this fiscal deficit, this is at 7. And if this fiscal bill gets passed, it's going to 8 pretty quickly. And nobody seems to really care other than people that are looking at 30-year bond yields.
Well, you know what they're going to care is when you can't afford housing because mortgage rates are so high. And they're like plugging into their head, okay, how do I afford this lifestyle? And so you go into essentially like you're going to have to, there's going to be so much social discord because those assets have to pass hands eventually. But, they're going to only have to do it through yield curve control. And I think we're probably within a year of that, I have to imagine.
I think that's roughly fair. I mean, the other thing to consider too, which Tyler, your slides last week kind of alluded to, is just the U.S. is exorbitantly reliant, at least at these asset valuations, on foreign capital coming into our markets and supporting them. And if at some point, whether or not tariffs was that catalyst, or it's other things, maybe it's it's enough, maybe it's just a bunch of little cuts that makes a big one, but erodes that foreign. Like you look at that, like you're a Canadian investor, you say like, okay, great, Mag 7 has been dominant, but if I can just plot Mag 7 versus US deficit spending, and I know that at some point that's not going to be able to continue, like maybe I should be out before everybody else gets out. So like it's one of those where you look at it and it seems like it's going to go on forever now, but I don't think that, like, I don't know. It depends your time horizon, but there's bumps along the way.
Yeah, that's why I can't get on board the US trade right now. It's just, it goes against my high level macro. I'd rather be in Bitcoin or in the rest of the world. Like, check out these stats. This kind of blew me away. So here are the days where the S&P and TLT are both down 1.5% or more on the same day, and the dollar is down 50 bips or more since 2010. The only 3 times in the last 15 years have been in the last 2 months where we've seen, US stocks down, US bonds down, and US dollar down. That is capital leaving the US. And this is a very new dynamic. Back in 2022, we had equities down, we had bonds down, but the dollar was surging. This is a completely different dynamic. And I think it just really shows that we're in a very unique macro regime right now.
I think the thing to think about with this chart, the first thing that comes to my mind is wow, and this is when our hard economic data is surprising to the upside. Imagine
Yeah.
that were to flip at some point, and then people are saying like, I mean, shit, they're, these days they're dumping everything dollar assets hand over fist. What happens if there's actually another new reason more structurally to sell?
Yeah, this data where you can see just the soft data had fell apart, and then it's rebounding ever since the tariff pause. But the hard data has still been pretty strong relatively. And this gets back to what we talked about a few weeks ago, where we said that we were likely to see this economic mirage for the next couple months, where because of this tariff front running dynamic, we are going to see some surprises to the upside in the economic data, whereas the whole market was priced for a recession, just barely a month ago. And then furthermore, we got the S&P PMIs today and saw a pretty significant bounce in that as well, which is interesting. Obviously, April was just in the absolute dumps, and we've seen a pretty good rebound. So I think this really goes to show what you're saying, is that we're in this situation where we'll have this temporary upsurge in economic data, but I think the situation will get a lot worse in the summer. Is that kind of how you're reading it?
I think, yeah, it could be more second half weighted than just summer. It's probably more like fall to winter. But yeah, we got to see where this bill shakes out. Like, I think there's still a lot to chop there. And then also, like Tyler mentioned, what probably does bring things down is when housing finally kind of just goes to sleep. And every little bump in economic data for the last 2 years has been accompanied by a smaller and smaller increase or recovery in the housing market, to the point where now there's just like no bounce. And I think that's where you'd start to run into trouble, because in many senses it's a key driver of economic activity here.
Yeah, it feels like the housing situation is starting to finally crack a bit. What's going on in Austin in the land of the real estate Ponzi, Tyler?
This is I hate this topic. Well, it's so polarizing because Austin went up like 100%, in 2 years, and then it moves down 5%, and everyone's like, "Oh, it's down 5%," and you're like, "Dude, it was on fire. It was better than Bitcoin returns for 2 years, whatever. I don't even know, but it was so." It's really hard to judge. I still think there's a mass influx into Texas in general, just from the coasts. And even if you get a little bit of softening from supply here, specifically in Texas, it's very regional, obviously. Like, I think Florida was overbuilt. There's a lot of risk there, especially given the weather, relative to Texas. But, I think the biggest risk right now is California real estate and New York real estate. In general, just that's the hardest place. But here's the other thing: they're gonna figure something out. They're gonna come up with an acronym. I mean, like, look, Fannie Mae's up 35% today. Trump's floating on, taking.
We're going public.
Yeah, and you're like, okay, here we go. They're just gonna juice it. They're gonna come up with another acronym. Markets are a political utility. Like, markets can't go down. If they go down, boomers will just vote them to go up.
Well, furthermore, housing can't go down, especially. This is what we're dealing with Canada right now. So we have a new prime minister, Mark Carney, came in, and there was talk of trying to make housing more affordable. And it's really funny to see them try to navigate the situation right now, because you have one generation that doesn't own houses that says, are you going to bring the price of houses down because I want to buy something? And then you have the other side of the base, which is, what the fuck? You can't bring down housing prices down. That's my retirement plan. And you can see these two dads. And so they're trying to navigate what to even say, because they can't say they want prices down. They can't say they want prices up. So they just can't say anything.
Dude, cut that down. What you just said there pretty much nails household formation, getting married. Like, that's the problem that we're all talking about on all these stupid podcasts, synopsized in just one little snippet. That Western world, that's exactly what's happening in the Western world. Is the assets of housing is causing like a delayed formation in getting married and having children. And so you can't actually like service the debts without printing money, because like you don't have population growth. So I don't know. I think you just absolutely tattooed it with that one.
How does that end, Tyler? Because you have inventories rising massively because like no one can afford it, but prices aren't budging. So
they'll buy the mortgages again. Oh, they'll buy them. You know, like we're past the point of no return here. I mean, let's be honest. The saving grace is you know, if you have AI that has massive productivity and everyone gets UBI or whatever it is, that's I think what they're trying to thread the needle here is like you get some big industrial revolution, which is possible. I mean, I'm open to the idea of that happening, but I don't know. I think the longer and longer, you know, that doesn't come, they'll just keep doing these funny little games. And that's the only thing, if you step back over the last 15 years or since 2008, really, that's the framework that's really worked is every time there's a sniff in the credit markets where, you know, these things can unwind. Like they could. I'm so bearish that I'm bullish. I've said that a million times, but like you can't, and we're at the point where if you actually let it crack, like Trump could have had the bond market crack and there'd be just massive credit crisis. But think about where that leads. It leads to like actual picketing. These politicians, there'll be people on their lawns. Like there would be people like actually trying to hang these guys because of all the imbalance.
I mean, that's kind of what you might need at some point to get good decisions made. But what, I mean, also isn't Trump like what people talk about, you know, the tariffs and this quote unquote flight of capital out of the US as being, you know, horrible. But you kind of, if you want to fix this, you need that because another, you know, it's the same in Canada and like Toronto, right? And in the US, all the foreign capital that bids up real estate here, like that's part of the problem. So either you do need some of that to flow outward or you just keep band-aiding the problem.
You can't have that and also run high deficits because they're the
Exactly.
ones that have been funding the deficit. You know, if any other country was running a 8% GDP fiscal deficit every year in, year out, there'd be a currency crisis. But it's because of that bid. So yes, you're right, but you can't have your cake and eat it too. And some's got to give. And right now, it feels like that's what the bond market's flagging out.
The bond market's flagging it and the corn is flagging it. I mean, Bitcoin's breaking out here to new highs. And I keep saying this, but global collateral is getting reanalyzed. We could watch like years and years of imbalances happen like that. And those things can change fast with a headline, but if you just take it for face value, you know, if you're Japan or some international, you know, net positive on a trade balance and you have inflation at home, which this might be a great transition to Japan, these things matter way more now because the demographics are so different. The inflation's different for Japan now than it was for 20 years. And that in itself, you know, they're repatriating all the savings now.
Yeah.
And they have to incentivize, you know, the next generations of growth. Otherwise, they're going to have nothing. So I don't know. Why don't we pivot to Japan?
Yeah, let's take with the so I got a little case study here. I want to show you guys and get your reaction on because there's some interesting canaries in the coal mine, I think, in Japan right now. So they had a 20-year JGB auction this week that just went horribly. The worst tail since 2012. This is a pretty interesting tidbit. For demand for super long bonds to rebound, the market wants to get greater assurance that there will be a reduction of new bond issuance, which is technically possible within this fiscal year. Sentiment will be weighed down ahead of auctions for 30-year bonds next week and 40 years the week after. But overall, this is a situation that's really interesting where obviously the big picture is that they've reversed out of yield curve control on the long end. Furthermore, they're trying to reduce their purchases of the long end and do quantitative tightening as well. And they're still in somewhat of a hiking cycle. And you're starting to see all of these dynamics come to a head in the long end of the JGBs. So we've seen, you know, the 20-year, the 30-year, the 40-year start to break out. The 40-year, which is a relatively new tenor, is hitting new highs. I think the 30-year is at new highs. And yeah, that has major spillover effects, which we can get into. But overall, it's really interesting. So this just looks at the flows, and you can see, so Japanese insurers are dumping their long bonds. And then as well, you have the BOJ, which is getting out as well. And there's been a negative headwind here. So you have both of these sides. You have, and I think you have a couple charts on this we can show in a second, Tyler, but inflation is creeping up in Japan. You know, they finally beat deflation. They have quite a bit of inflation. But overall, you have these dynamics. you have this is just looking at the current rate path for the BOJ. So they're still in a hiking regime somewhat. But at this juncture, it's like, who's going to buy these JGBs? Who's going to cover it if they're trying to get out? And then what's the impact of that on other global bond yields? And I found this really interesting too. This one of these last charts here is just looking at the yen positioning for this right now. Is that hedge funds are absurdly long yen, and so for me, this is like an interesting tension point because it feels like a lot of this is speculative positioning based on some sort of currency agreement with Scott Bessent and Japan, hoping for, the big hope is that the yen will strengthen meaningfully. But you pair that with what we're seeing in terms of the bond yield just completely losing itself right now and no meaningful buyer stepping up. And it's like, who's going to show up? And then lastly, you just have this piece from Scott Bessent and the Bank of Japan and the Ministry of Finance, met yesterday at the G7 meeting just here in Canada. And they mentioned this, which is they reaffirmed their shared belief that exchange rates should be market determined and that at present, the dollar yen exchange rate reflects fundamentals. As in their previous meeting, they did not discuss foreign exchange levels. So there's a few different dynamics there. The way I put this all together is it feels like they're losing the long end of JGBs. There's this hope for yen strengthening, but that would also come with further upside in JGB bond yields. And it just feels like they're where the US may well end up in 10 years time or whatever, where like this is all coming to a head. So I just want to use that little case study. Yeah, get in there, Tyler. What's up?
Well, I just want to make a really short-term prediction. If I'm going to actually just put my trader anti-consensus hat on, is we get Japanese CPI tonight. So by the time this airs, looking at that positioning, I bet the yen weakens massively. The CPI comes in lower and Japanese bond yields kind of slam down in the short term. But in the long term, I agree. These are secular trends where yields probably keep going higher and higher, just given demographics and wages. But yeah, that positioning looks stretched to me, and I think everyone, like in the short term, I could see the yen really weakening, the dollar strengthening, and we'll see if that's right. But two charts I wanted to show on the Japanese inflation is kind of interesting. Is Russell Clark talks about food prices. He's really, a big believer that when food prices rise, that's a sign that labor needs their wages higher. And when labor needs their wages higher, that's what really causes interest rates to actually rise, because, the price of goods, of commodities, rises when more of the labor pool has a larger share of the financialized pie. So this is just Japanese, food CPI for the past couple of years. Food prices are up 25%. And like, there was something he talks about, Russell Clark, which would be a great guest to get, by the way, where during 2020, you'd think that Japanese bond yields would have gone lower because it was a massively deflationary event. But in 2020, Japanese bond yields actually reversed that. So something happened globally in terms of the capital flows in COVID, where, it was maybe demographic, it was, maybe policy wise, but Japanese bond yields started rising at that point, which was a complete flip on its head, maybe to a secularly inflationary environment from a secularly disinflationary or deflationary environment. And anyway, so here's food prices rising in Japan. And then you have, if you go to the next chart too, this is just beef prices in general. So, if you just look at food prices, then you kind of pretend, okay, here's where, labor, they need to pay for their groceries. That's when they really go crazy. It's not like, oh, I can't pay for a house. Like, you end up spending on going traveling, whatever. When you get hit in like the food price department, that's when you go to your boss and you say, screw you, I need a raise. And then you unionize and you say, hey, I need this for my family because I'm not putting food on the table. And that's when you really get, social discord. So we've seen actually Japanese labor unions argue for, wage price hikes, which is, I think that's really, this force that Russell talks about is really the driving force of probably the globe, because Japan was the net saving, the second largest like reserves, foreign forex reserves in the entire world. And so they would take their savings and go deposit in different countries to get, yield on that, right? That they were one of the largest bond buyers. Now, if the next generation is like, crap, we have all this inflation at home and food. We need to repatriate that money and invest here. So I think Japan is really ground zero for what global capital flows and why they matter way more than like, what we knew of PE and multiple investing and the factory lines of fundamentals. That don't work no more. I mean, I shouldn't say that. It kind of works. I would actually say like having a big macro view matters. If you can overlay that, it should really help it. But flows are telling you way more. Like money's coming out of the US and going into Germany and Europe and these other countries, and you're seeing that work. Just big geopolitical things can actually help you outperform now better than fundamental investing, which is kind of funky. And I'll just keep harping on that every week.
This episode's sponsor is Blockdaemon. It's the gateway to the decentralized economy. If you're serious about crypto infrastructure, Blockdaemon is the partner trusted by top-tier financial institutions and the biggest names in Web3. They're the #1 institutional staking provider by volume, managing over 250,000 nodes globally with over 70 points of presence. Their ISO 27001 certification and slashing risk protection means your assets and operations are backed by audited security standards and 24/7 monitoring. Whether you need secure notes, MPC wallets, or staking at scale, Blockdaemon delivers enterprise-grade reliability and peace of mind. Visit blockdaemon.com to get started or book a call with their team today. Let's take a moment to talk about Echo Protocol, one of the fastest growing DeFi platforms on Aptos. Echo is pioneering Bitcoin, liquid staking, and restaking in the Move ecosystem with over $260 million in TVL and deep traction across DeFi protocols. Here's how it works. Bridge your Bitcoin or Bitcoin liquid staking tokens into the Echo ecosystem, mint a BTC, Echo's yield-generating BTC primitive, use a BTC in EchoLend to maximize returns, or stake Aptos to mint EAPT, giving you exposure to liquid restaking opportunities across the Move VM. With a mission to unlock the full potential of Bitcoin, Echo is quickly becoming a cornerstone of the Move-based DeFi world. Check out echoprotocol.xyz and start earning with your Bitcoin today. Meet Arkham, the world's first crypto exchange powered by crypto intelligence. Arkham allows you to review on-chain data, see what the top traders are doing, and then act on that information with Arkham Exchange. They've made blockchain data human readable with features like profilers, visualizers, and custom dashboards, making it useful and actionable for everyday crypto users. Arkham believes that transaction analysis, the study of wallet activity and fund flows, will match or even eclipse traditional technical and fundamental analysis. And in a cycle full of hacks, rugs, and scam bundled launches, the best protection is knowing who's moving funds and where they're going. That's crypto intelligence, and that's what powers Arkham. Head to Arkham.com to start tracking wallets, following flows, and trading with an edge. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research. Nailed it. Quinn, do you want to talk about the pass-through of that into potentially U.S. assets? Because I know you've been focused a lot on the long end of the U.S. bond market, and it just feels like these two narratives are really tied together. Because like Harley said, Japan's been the big buyer of U.S. assets, especially, treasuries. And it just feels like something's coming to a head. I don't know when.
We've become so accustomed to everything getting smoothed over. But what I think people ignore when they rush to the bond market's imploding, QE and is next month type of thought is that would send inflation to the roof. And that if there's anything the Trump team knows and globally politicians know, you want a quick way out of office, that is let inflation run hot. Like asset prices is obviously you want those high, but inflation is very, it's probably top 2, maybe 3, maybe 1 reason why Biden lost. This, like, if you go back to any debate, any Trump hit over the head the inflation problem tremendously, and that's a problem. Like you people can't afford stuff. So if you're Japan here, everyone's like, oh, the curve's imploding. Well, globally, yield curves are extremely flat relative to history. So you could get 100 to 150 bips of the twos 10s or twos 30s or threes 10s, whatever, steepening, and it would be completely normal in history. So I think people need to, we're anchored to this manipulated curve environment the last couple of years post COVID, but it's normal to have a cost of money for time. And the other thing is, if you're Japan, I think why those bets and positioning are so long the yen is they're sort of dancing with the devil here, because for market stability at the US asset level, you don't want the yen to go from 140 to 120 in 3 months. But there's a point where, if, as Tyler pointed out, they can't just sit here. Like, if they don't let the yields normalize and rise, the yen's going to get smoked. Those food prices are going to go up even more. They're net importers of everything, energy, all these goods. And their inflation problem is a good 1.5 ahead or more everybody else's, than in the West. Like, they're well above 3. So that's what I think people, it is important to watch, because like the idea that Japan just is going to QE again with inflation actually problematic today, I see why that yen positioning is the way it is. I don't have a good, strong, high conviction view right now on FX. So I'm not playing it, but I think it seems to me there's other better ways to play it in the bond market. But yeah, they can't just, if inflation is a problem, you just can't QE. Like, it's not that easy. So that's what I think we're going to run into globally in the next 6 to 9 months.
Isn't it funny, like, when you just analyze this from existentially, like an incentive-based system politically, is like you put band-aids on stuff for 40 years, and now you're at this point where it's like, oh shit, we got to do surgery. Like,
Yeah.
oh God, we're trying to
but they're still in denial. They're still running it hot.
I don't know. I'm watching like Bitcoin's almost crossing like 112 here, and I'm like, people are starting to sniff out like, okay, where the hell do I put my savings? Like, I think gold's obviously done that okay. When the con game is up, like, this is clearly all just a confidence game, and I think more and more people are like, oh shit, like, what's the out here? If Japan does QE and the US does QE, we could be watching stocks go freaking like blast off. And show chart number 34 here. This is kind of really interesting. This is the Morgan Stanley Momentum Index. The MACD is turning up here and almost like breaking out to new highs. And this is where I think by one trade, I really kind of mean like you just have to pile into the fastest growing stuff to, hold your purchasing power. And the momentum basket has done this actually extraordinarily well. It's, obviously like the fast growing, high beta stocks, but this thing looks like it's going to take off here in this whole, in the backdrop of all this.
Yeah. So I feel like the big issue at hand of how to navigate this is, okay, higher yields. And then you have to think about, do we see that fracturing moment before we get the next wave? Do we see that margin call moment or whatever? Because the long end is losing itself. And to your point, Quinn, I don't think the acronym factory is as close as it is right now as it has been in history in terms of the Fed coming on board. But I just want to show a few slides in terms of like the liquidity dynamics right now. And I've been heavily in the camp that things are fine. It feels like every month somebody's saying QE needs to happen soon. And we've been kind of beating that down. But for anybody that hasn't seen this before, this is what I think is the best way to gauge like Fed plumbing liquidity dynamics right now. And this is actually a model that the New York Fed has created called reserve demand elasticity. And you can see, I've talked about it on the show before, but during 2019, 2020 is when it went severely negative. And those were the times where the Fed came in. This was the repo crisis. This was when they had to end QT overnight and all these things and actually move towards cutting pretty quickly, even before COVID happened. And so we've been chopping around near the zero level for quite a long time. We've had a pretty fat reverse repo balance that's been offsetting a lot of these liquidity strains. So things have been fine. There's been the focus of tilting issuance to bills for the Treasury as opposed to coupon. But you're starting to see now, this is just that same model zoomed in a bit more, we're starting to really start to trickle downward lower, which is really interesting to me. And then furthermore, is if you look at swap spreads right now, which is also back at the lows of Liberation Day, which is really interesting to me because this is just another proxy, I think, for looking at just like the cost of leverage in terms of treasury collateral. So I'm starting to see some whispers of collateral scarcity in the funding markets, which I think is pretty concerning when you pair that with where the long end is right now. And then furthermore, like you have the TGA needs to get rebuilt in once the debt ceiling gets resolved. And this time that's being done without any balance in the reverse repo. Like the way they funded that last time was just running the RRP to zero. But that's not there this time. So I don't know. I'm curious on you guys' take, but it feels like the tail risk of a little fracturing moment is somewhat high. And then you just have to decide yourself as a risk manager, as a trader, if you know that on the other side of this comes everything you just talked about, Tyler, in terms of, the horses come to save the day. But do you want to just ride through that? Do you want to trade it? Do you want to hedge it? That's for everybody else to decide. But it does feel like there is some constraining factors that I haven't seen basically since QE started in 2020.
If they were to react, Japan or US, in a QE type of way today, and inflation expectations are already out of becoming unanchored, like, I don't know how good that is. Like, stocks are near all-time highs in almost every global market. That's how you get the inflation problem that causes the years like 2022. Like, they should just try and be normal. And like, it just shows how unstable the markets are. Like, I don't think you want this dramatic QE.
What's weird is they're unstable in some ways. Like when you look at that, but credit spreads are kind of fine. If you look at break evens, they're not extraordinarily like on wildfire. I think this is just a sovereign balance sheet thing, where you have to figure out a way to fund your government.
Yeah, I think liquidity is fine right now. I think it's going to be an issue in the early fall.
Yeah, so we'll see when we get there, but I think everyone's kind of adding up. This is sort of the end game of whatever this generational thing is, and I just think we're going to end up massive asset inflation more than anything else.
Yeah, I do too, and I feel like that's where I feel okay to risk that fracturing moment if I'm in gold and Bitcoin, because I know that on the other side of that comes what we're saying there is. But then when I look at like US assets and US equities, when we look at those headwinds of capital repatriation, I don't feel as confident wanting to hold through that dynamic. I don't know about you guys.
True. Yeah, that's the big question mark to me. Is like, does some of the global capital flows settle down, and do you get I don't know, just Japan calm down, does China calm down, and you have like a global peace dividend, and in that's the Goldilocks scenario where the world just works better.
I mean, presumably, Tyler, if people are correct in that the US is heading towards Japan, that's really bad for equity markets. That's multiples. I think the thing to remember,
I think stocks went up in Weimar Germany. I mean, it's selective. It's probably, you're going to different areas to retain your purchasing power. Like maybe it's all the piling in of, largely tech has been the inverse of energy stocks. And if you think about the centralization that tech has had, has only been allowed because you had like globally disinflationary backdrop. And if those things are reversing, the innovation from tech is going to probably drop, relatively speaking.
Well, that's what I'm saying. Japan's stock market is below where it was on January 1st, 24. So it's not good. And the other thing to remember here is when you're buying a stock, like, or let's just say the US index that's trading at, 20 some times now, it's back to basically where it was pre tariff, pre whole sell off. You're not just betting on growth. You're betting on growth plus sustained, capital inflow mode. Plus you're betting on so much more, than just the company's earnings holding up. So that's why I think, Felix, you're right to point out the risks, because in this world where inflation comes back, or the US has to eventually stepping into, being required to do QE is damaging to investor confidence more than it is helping, right? We're kind of at some point here crossing the Rubicon where it's like, okay, when we're at pure panic and you step in, you're at the floor, there's a lot of room to go up. When you're having to step in at the ceiling, it's kind of the other way around.
That's why I'm so bullish the rest of the world, because like look at the fiscal capacity of other countries. Like the US is fully maxed out, and you have these these headwinds of capital repatriation. But if the rest of the world, if Germany's unloading their debt brake, they're going to start spending money. If you just look at the rest of the world that has been underspending, if they go from a fiscal deficit of 2% to 5%, that feels like they have a lot more fiscal capacity and a lot of a cleaner trade to own that versus US. And overall, this is why I'm also still so bullish Bitcoin, is that Bitcoin's a global asset. It's gonna take into account the rest of the world, which is heading in that direction too. So if I just own those and then just not own the US, I can isolate away from those risks. That's how I see it.
I mean, who would buy a duration bond right now in the US? I mean, that is just like, that is insane.
Here's an argument to why,
or anywhere.
For this reason, this is a reason why stocks and Bitcoin might be the only out, is like you've been in a giant debt bubble for 40 years. And if that money just kind of like comes out of the debt markets and goes into stocks, like it's going to push everything up. And so prices.
I think you can say that, but for any stock market that's not at all-time high multiples. Like, I don't think it's a prudent bet to say I'm going to bet on US equity multiples going from record high 23 to 30. I'll take that bet globally, like in a market with tailwinds in the equity markets at 10x. But like, I don't feel like that's a good proposition at 23 at where we're at.
I think it's sector specific, to your point, is like some
100%.
Some stuff's going to get roasted, but
100%.
Yeah, it's a weird. I think what worked, the massive, inflows to your automatic inflow to your 401k into S&P is going to be, that's a recipe for disaster. And there's going to be great strategies that take advantage of that whole ecosystem, I think, going forward.
I mean, look at this chart of outflows from US small cap stocks. I saw this today and it blew my mind. Look at those outflows, record outflows. Like,
small business is just getting murdered.
Doesn't this tell you, this is part of my like political framework, which is this should be when you have this, you're just living in a centrally planned economy with the stock market close to all-time highs. It's just like the winners, you've already had monopolies and your small caps can't like keep up with the centralized planning, of the large cap indices and the centralized flows. It's really terrible. Most of the innovation should come from like your small cap universe.
I'm trying to pull up this chart and get it in the deck really quick, but the fun one to watch is those ETFs that are mutual funds that are the Vanguard retirement accounts. And so like here's the 2030 on a weekly. I'll post it in.
I will just add that it is also interesting that, when you think about this regime we're in terms of rates, small cap funds itself on floating rate, Apple funds itself on fixed rate, and so you have the situation where Fed funds has just been high for so much longer than a lot of people expected, that they need to start to refinance their floating rate debt at much higher rates, and that hits them right away. So I also see the fundamental reason why small cap is just so strained here, unless we get like meaningful rate cuts.
Yeah, it's I put it slide 3, Felix, which this is like for Tyler's boomer Ponzi. This is the perfect boomer Ponzi meter, because this is the 2030 Vanguard retirement mutual fund. And that's at levels that's at 2020, December 2021 levels. Like, this shows how bad bonds are, because this thing's probably like 50 or 60% bonds. And
they're just not doing anything. Like, why would you invest? It's crazy.
Keep in mind, this is in nominal terms. And how much inflation have we had since December 2021? A lot. So like, your real returns, there's a big cost. It's just mind-boggling to think about, like, the average person's retirement account options is like all of this crap.
And then you circle back to what we talked about at the beginning of the show, where Scott Bessen's talking about running the economy hot to run out of debt. That's telling you that this is going to continue.
Mm-hmm.
Yeah, it's basically just taxing the boomers who are sitting in the fixed income, and that's like the way you got to do it. That's like you can't crater their net worth like in their house prices and all this, but you just tax the hell out of them by they're all sitting in fixed income because they retire in 5 to 10 years. So they're like 10% stocks, 90% fixed income, and you make the real returns just disgusting.
The irony of that whole thing is that you'd think you'd be looking at your portfolio and being like, I'm not making money and I'm getting eaten up by inflation. How do I, asking yourself the question, like boomers should be actually asking like, why is this Bitcoin thing like crushing? But I don't think their world is completely different. They came from like their brothers and sisters getting drafted in Vietnam, and like to ask about a cryptocurrency is like, think about that transfer of history. Like, but we can do it because we're like,
future is now, old man.
We've been through a financial crisis, a pandemic. We don't work in offices anymore. Like, there's like some malleability to millennial and Gen Z brains to a certain extent. Gen Xers, I find, what is really fascinating is like just the generational difference. I don't know if you found this in the workforce, where it's like Gen Xers are just on the cusp where they're in like power positions of more of the older mainstream organizations that like they're probably making enough money to like satiate themselves on the inflation, and to get to this like new industry or like new capital base of like Bitcoin or fiat, cryptocurrency. But then you listen to a guy like Jack Mallers, and he's like, talking about Jeff Epstein's banker, and like it makes so much sense to me relative to, these guys that are all benefiting from this system, but then these other guys that are just crushing it in the new system. And there's this whole horde of people in between, which is basically me. And it's like, should I jump into the crypto full time, or should I stay in the legacy hedge fund world? And eventually I think there's one thing. It's like, you have to be on the frontiers. Otherwise you're going to get crushed. Like, think about if you're at like Fox or CNN now, and you're watching just mainstream news eat itself. All these weird incentives are like, you have to wait for someone to die to get a promotion. And meanwhile, you can just like, Blockworks is growing like mad. You get promotions. Felix getting new artwork. I think that's Matisse in the background.
Oh yeah, buddy, it is.
I mean, come on, this says it all.
Yeah, man, those ads are going, those Blockwork ads are going straight into Matisse paintings.
I feel like Tyler reads off a script the whole episode where it's all his like predefined smart stuff he's gonna say, and his brain power the whole time is just thinking about like, what can I say to chirp? Like, he's like, and he ends every smart thing with just a jab.
Yeah, can we read The Man in the Arena again?
Yeah. The problem with Tyler is he's like fucking 6'8", so huge, so you can't give it back to him.
Man, we're gonna have a stacked panel at Permissionless, looking at our height statures. I mean, Quinn, you're pretty tall, but Tyler and I are. Well, I mean, I haven't met Tyler yet in person, but we'll see.
Felix like 6'3", 6'4". We're probably the same size.
Yeah.
Anyway,
all right, guys, we'll leave it at that before we go on too many tangents. But yeah, another great one.
Yep. Always good to laugh.
Good weekend. It's a Memorial Day holiday down here, so enjoy it. Do you guys have something like that, Felix?
Yeah, ours was last weekend. For some reason, they just didn't want to line it up, so I was out Monday. But
it's like your guys' Thanksgiving.
I know, it's
like
so
in
weird.
like
We just
July,
try to be unique
right?
for
some
no
random
reason.
Shit.
Man, we didn't even have, like,
it.
I don't know. Thanksgiving was just like us trying to copy the Americans just because we're jealous of them or something. Like,
you know what I got to get to is Calgary Stampede. Is that July?
Oh, dude, I'm going. And I was there last year. It's the best time.
Calgary. We should do Blockworks Calgary.
Yes.
We should do it. We'll have a
booth. Blockworks Calgary. We'll set up a good dinner. Charge some charge a fee for a dinner. Come on, let's do it.
Yeah. Let's go to the rodeo. I love it.
Yeah.
All right, guys.
All right.
Beauty.
Catch you.
Peace out.